Okay, so maybe you're feeling a bit like you're on the outside looking in when it comes to investing. You see the headlines, the stock tickers, the crypto news, and it just feels overwhelming.
Yeah, it definitely can seem that way at first, like a whole different language almost.
Exactly. But you're in the right place. This deep dive, well, it's your fast track. We want to cut through the noise and get you the essentials for investing in the stock market and crypto, specifically for 2025.
Right. We're aiming to really distill the key takeaways. We're drawing from a Smart Money Moves episode, the one called Investing for Beginners, Stock Market and Crypto in 2025 with Sam and Ria.
And our mission here is pretty straightforward. Help you as a beginner understand how to actually start investing wisely, avoid those common mistakes everyone seems to make, and build a basic portfolio that works right now.
Let's get into it then. The absolute basics first. Saving versus investing. What's the deal?
Good question. Saving is, well, putting money aside, maybe in a bank account, it feels safe, but investing.
Investing is about making that money work for you. See, money sitting in a savings account, it often loses purchasing power over time because of inflation. Prices go up.
Ah, right, inflation. So your saved cash buys less later on.
Precisely. Investing aims to grow your money, ideally faster than inflation, so you actually build wealth over the long run.
Okay, and this isn't the same as like frantically buying and selling stocks every day, trying to make quick cash. That seems really stressful.
Totally different. That's trading.
Yeah.
Short term, speculative,
Yeah.
often very high risk. What we're focusing on here is investing,
Which means
thinking long term, like 3 years, 5 years, 10 years, even longer. You buy assets, you hold them, you let them potentially grow and benefit from compounding.
compounding. That's where your returns start earning their own returns.
Exactly. It's like a snowball effect. That's how real sustainable wealth is often built. It's not about getting rich overnight.
Got it. Okay, let's tackle the stock market. It sounds so big and complicated. What is it, fundamentally?
Think of it simply as a marketplace. Companies need money to grow, right? So they offer small pieces of ownership to the public.
Those are the stocks or shares.
Yep. When you buy a share of, say, Apple, you own a tiny fraction of Apple. The stock market is just where those shares get bought and sold between investors.
Okay, makes sense. Now, these terms, index funds, ETFs, I hear them all the time. Are they too complex for someone starting out?
Oh, actually, no. They're some of the best places for beginners to start.
Really?
An index fund is basically a basket.
A basket of stocks.
Exactly. A basket designed to mimic a whole market index, like the S&P 500. That's the top 500 or so U.S. companies.
So if you buy into that fund, you instantly own a tiny piece of all those companies.
You got it. Instant diversification across a huge part of the market. It spreads your risk.
And ETFs. How are they different? Exchange traded funds.
Very similar idea. They also hold a collection of assets, usually tracking an index, just like an index fund. The main difference is how they trade. ETFs trade on the stock exchange just like an individual stock. You can buy or sell them anytime the market is open. Index funds usually price just once a day. Plus, ETFs often have slightly lower fees, which adds up.
So both are good for beginners because they spread the risk instead of betting everything on one company.
That's the core benefit, yes. If one company in your ETF or index fund doesn't do well, it doesn't sink your whole investment. You're betting on the market's overall growth, not just one horse.
That sounds much more sensible for a beginner. Okay, practicalities. How do I actually buy one of these? Do I need, like, a guy in a suit? A broker?
Uh-huh. Not usually anymore.
Yeah.
It's way easier now.
Oh.
Online platforms are the way to go. The source mentions Zerodha in India, Robinhood, Grow, Fidelity, lots of options.
And what do I need to open an account?
Typically, you'll need what's called a Demat account in places like India and a trading account pretty much everywhere. You link your bank account, verify your identity, standard stuff.
Do I need a lot of money?
That's the great thing, no. You can often start really small, like 500 rupees, maybe $10. Some platforms even let you buy fractional shares.
Fractional shares, meaning I don't even have to buy one whole share if it's expensive.
Exactly. You could buy, say, $20 worth of an ETF, even if one share costs $200. It really lowers the barrier to entry.
Wow, okay. That makes it feel much more doable.
Yeah.
Now, let's talk mistakes. What are the big traps beginners fall into?
Oh, there are a few common ones. The biggest is probably the get-rich-quick mentality.
Chasing hot stocks, listening to tips from friends.
Yeah, exactly that. Or buying based on hype or some rumor you heard online. And panic selling. The market dips, which is normal, and people freak out and sell at a loss.
Yeah.
Emotion takes over.
Right. Fear and greed. The classic pitfalls. What else?
Not doing your own research is another big one. Just buying something because someone recommended it without actually understanding what the company does or if it's financially sound.
So even for an index fund, you should understand what index it tracks.
At a minimum, yes. Understand the basics of what you're putting your money into. Don't just follow blindly.
Makes sense. And what about putting all your eggs in one basket? Is that common?
Unfortunately, yes. Lack of diversification. Pouring everything into one single stock, maybe the company you work for, or one hot sector. That's incredibly risky. If that one thing goes south, you're in trouble.
Okay, so diversify, spread it out. What about watching your investments like a hawk, checking the app every 5 minutes?
Yeah, that's generally not helpful. It just causes stress. Markets fluctuate daily, hourly even. Watching constantly tempts you to make impulsive, short-sighted decisions.
So it undermines the long-term plan we talked about.
Absolutely. Better to check maybe monthly or quarterly. Set your plan, stick to it, review periodically. Investing isn't gambling.
Right. You said earlier, good investing is often kind of boring.
It often is. It's about discipline, consistency, patience, and letting compounding do its thing over years. It's not about constant action and excitement. That's trading or gambling.
Okay. Boring, but potentially effective. I like that. Let's switch gears to cryptocurrency. Still a huge topic in 2025, right? But it feels even wilder than stocks.
It definitely is wilder. Much higher volatility. Beginners absolutely need to approach crypto with caution. Prices can swing dramatically, much more than the broad stock market.
And why is that? Is it because they aren't backed by, like, company profits?
That's a big part of it. Unlike stocks, which represent ownership in a company with assets and earnings, most cryptos don't have that intrinsic backing. Their value is driven more by supply, demand, sentiment. It makes them more like digital commodities and highly speculative.
So if I'm a beginner but I'm curious, how should I even think about approaching it?
Very carefully. The recommendation is usually to allocate only a very small percentage of your total investment portfolio to crypto.
That's small.
Maybe 1% to 5% at the absolute most for a beginner. Think of it as the riskiest slice of your pie. Money you can genuinely afford to lose.
Afford to lose. That's key.
Yeah.
Okay, and there are thousands of cryptos. Where does a beginner even start?
Stick to the biggest, most established ones for starters. That generally means Bitcoin and Ethereum.
Why those two?
They have the longest track record, the largest market value, the most infrastructure built around them. They're still volatile, make no mistake, but generally seen as less risky than the thousands of smaller, newer coins.
And where do you actually buy Bitcoin or Ethereum?
You need to use a reputable cryptocurrency exchange. Some well-known ones are Coinbase, Binance, maybe CoinDCX, depending on where you are. Security is really important here.
And just to hammer this home, this is not money you need for rent or food or emergencies, right?
Absolutely not.
Yeah.
Never, ever use emergency savings or money you can't afford to lose for crypto investments. The risk of significant loss is very real. Treat it as speculation within a broader, more stable plan.
Okay, super clear on the caution needed there. So let's try to bring this all together. For a beginner in 2025, wanting to dip their toes into both stocks and maybe a tiny bit of crypto, what could a starting portfolio actually look like?
All right, let's sketch out a sample allocation. This is just an example, remember. You might have, say, the bulk of it, maybe 70% in those broad index funds or ETFs we talked about.
Like an S&P 500 fund or maybe a Nifty 50 for India or a NASDAQ fund for tech exposure.
Exactly. Diversified core holdings. Then maybe add another 20% in individual stocks, but focusing on blue chips.
Blue chips, those are the big, stable, well-known companies like Apple or Reliance or Infosys.
Correct. Companies with a long history, solid financials, generally considered less volatile than smaller growth stocks. So that's 90% in stocks, mostly diversified.
Okay, where does the rest go?
Then you could have that small speculative slice, maybe 5% in crypto, perhaps split between Bitcoin and Ethereum.
All right, 70% ETFs, 20% blue chips, 5% crypto. That leaves 5%.
Right. Keep that last 5% perhaps in cash or a very low-risk debt fund or money market fund. This gives you some flexibility maybe to invest more if the market dips or just for peace of mind.
So 70-20, 5-5. That feels balanced. It's got growth potential, some stability, a tiny bit of high-risk exposure, and some cash.
Exactly. It's a starting point. It provides balance. And crucially, it's not set in stone.
Meaning you can adjust it later as you learn more or your situation changes.
Absolutely. As you get more comfortable, maybe your risk tolerance changes, your goals evolve, you adjust the percentages. But this kind of model gives a solid, diversified foundation to begin with.
This has been incredibly helpful. Before we finish, any final top tips for someone listening who's ready to actually start?
Okay, final thoughts. Number one, just start now. Don't wait for the perfect time because it probably doesn't exist. Even small amounts count.
Get the ball rolling. What else?
Number two, keep learning. Read books. The Psychology of Money, Rich Dad, Poor Dad are good starting points mentioned. Follow reputable financial news. Education is ongoing.
Okay. Learn continuously.
3, beware of hype. Don't just jump on bandwagons. Do your own basic research. Have a reason why you're investing in something.
Got it. Think for yourself.
4, be consistent. Investing small amounts regularly, like $20 or $50 a month if that's what you can manage, adds up massively over time, thanks to compounding. It's powerful.
Consistency is key. And the last one.
Stay calm during downturns. Markets go up and down. It's normal. Don't panic sell. Focus on your long-term goals. Dips can even be opportunities if you have a long horizon.
Start now. Keep learning. Avoid hype. Be consistent. Stay calm. That's great advice. It really does feel much less scary now.
It's achievable. Patience and discipline are your best friends here. Honestly, your future self will likely thank you for getting started today, even if it feels small.
So recapping the whole thing, getting started in 2025 with stocks, maybe even a bit of crypto, it's definitely possible for beginners with the right approach and the right mindset.
Absolutely. Take those first steps, build knowledge gradually, be patient. You can do this.
Okay, so for you listening right now, which part of this feels most like your first step? Is it the stock market side, maybe exploring those index funds or ETFs? Or are you curious about taking that small, cautious step into Bitcoin or Ethereum?
Yeah, think about that. And maybe as a concrete next step, actually look up one of the index funds we mentioned, like an S&P 500 ETF, or research one of those blue chip stocks, see how they work, what they hold. Just start exploring.
And finally, just a thought to leave you with. We've talked about traditional markets and these newer crypto assets. Looking ahead, maybe over the next decade, what does a truly diversified, resilient portfolio actually look like? How might these different pieces fit together for the long haul? Something to ponder as you start your journey.